Let's get started. So my name is Mark Lamonica. I'm the product manager for Morningstar Premium, morningstar.com.au. And today we're going to talk about preparing your portfolio for retirement. So hopefully this will be valuable for people that are preparing their portfolio for retirement, but even people that are a little earlier in their investing life. First, we have to go through all of our fun housekeeping items. So the first one is anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. And for our Kiwi friends, a couple things. Number one, you can go to our website, morningstar.com.au, and get a copy of the FAP disclosure. Thank you. Before we start these things, every single time Shawnee says, "Do you remember the disclosure?" And the answer is no, and I kind of fuddle my way through it. The other thing is, of course, if you are in New Zealand, or I guess anywhere, and you want personal financial advice, you can go to a financial advisor. So there we go. Shawnee's nodding approvingly, which is rare. Also, we'd like questions. So there's a Q&A button. I would like questions. I guess it's just me. There's a Q&A button on there. So send through questions. The one on Tuesday, we didn't get any questions until right at the end when we got a ton of questions. But yeah, ask them early. All right, let's do this. Who's ready to learn about retirement? Okay, there we go. Preparing your portfolio for retirement. We have a question. It's a statement from Paul King, is a financial advisor in New Zealand. So whenever I say nobody from New Zealand joins these things, why do we have to do the special New Zealand disclosure? I've now been proven wrong. So thank you, Paul. Welcome. I hope things are going well over there. All right, so first, we're going to talk about a lot of different things today. We're going to talk about withdrawal rates and sequencing risk. We're going to look at asset allocation in retirement. So we've got some suggested asset allocation that Shawnee was kind enough to put together slides for. So you'll see some differences in the slides. You'll see the terrible ones that I did in the beginning, and then Shawnee's nice slides at the end. So this will be exciting. But we'll talk about, asset allocation and sort of the different ways you can approach retirement. So let's start with something that hopefully you guys have all heard about. It's called the 4% rule. So we'll go back and give a little bit of a history of the 4% rule. So there's a financial advisor in the US in 1994. And of course, one of the big things that financial advisors often deal with is people transitioning into retirement. And the big question is, of course, you've spent your whole life saving money and building this portfolio. Then you want to figure out how much you can take out of it. And the problem you're confronted with retirement planning is you don't know when you're going to die. So it's very, very hard to plan anything when you don't know the time period you're planning it. So the conundrum that everyone has in retirement is, unless you like your kids, you want to spend your money, and you want to spend your money while you can, but you also don't want to spend it all before you die, because that's a problem. So this financial advisor, because he got these questions all the time, he decided, okay, well, why don't I go back and look at historical market returns and figure out what is a safe withdrawal rate? So here's the one that came up with the 4% rule. So basically what he did is he went back to, I think, 1925. So remember, this is 1994. And he went back and he looked at equity and fixed income returns for every year over that period. And he essentially ran a Monte Carlo simulation on that, where he's doing all the different combinations. So basically all the different sequences of returns, because sequencing of returns is important, which we'll talk about in a second. So he goes back and he looks at this, and he then looked at a drawdown period of 30 years. So it's a very important number, 30 years. So this is not a 50-year retirement. This is not a 60-year retirement. It's 30 years. And I'll get to why that's important in a second. And he looked at all these different scenarios and tried to figure out if you would run out of money based on any of these different scenarios. And so what he came up with was the 4% rule. And the 4% rule was his safe scenario for withdrawing funds. Now, a couple things are really important about this. Number one, 4% rule only works for 30 years. The reason I say this is because in my laziness to create this slide, I got it from something called Camp FIRE. So if people have not heard of FIRE, it is financially independent, retire early. Will's looking very confused. I'm not used to Will paying attention. He keeps adjusting the camera. The secret with me is zoom out. Anyway, 30 years. So FIRE, this financially independent, retire early, has taken up this 4% rule mantra and that basically means that people want to retire in their 30s or 40s. They want to retire very early. And they've all been told by a lot of these FIRE movements that the 4% rule is how you figure out if you can retire. And it only works for 30 years. So if you're retiring and you're 40, with the 4% rule, you're not going to make it. So it's important that we understand that this only applies to retirement. The other thing that's really important to remember about this is that this whole thing happened in a very different market environment. So just realize that he was using a 60-40 portfolio, so 60% equities, 40% bonds, and he was running that at a time where bonds in particular were returning a lot more. So I think his return for bonds, go back and look at historical returns for bonds, something like 5-6% a year. And that's because we went through a very long period, sort of starting in the mid 80s, where interest rates went down. And of course, when interest rates go down, bond prices go up. So where we sit right now, I would just be wary about blindly following the 4% rule, because you're not getting anything from bonds, you're not getting anything from cash. And so, of course, you're using your equity, the equity portion of your portfolio, to do the heavy lifting. So something to think about. Now, why does the 4% rule matter for other people? It doesn't have to be the 4%. You can be more conservative and say 3%. But why does this percentage withdrawal rate matter? Because for anyone at any age, you can calculate how big your retirement portfolio needs to be to support your lifestyle. So we did a podcast, our most popular podcast, Shani. We did a podcast where we took Shani through her retirement scenario. Now, Shani says she's going to retire in 38 years, so it's obviously a long time away. 37 years now. Yes, Shani turned older. Shani had a birthday. And so we were looking at her portfolio. And one of the things that's easier for us to do is it's easier for us to imagine how much money we're going to spend on a dollar basis rather than looking at a portfolio. So all you got to do if you want to have $100,000 a year generated out of your portfolio, remember inflation, just divide that by 4% or whatever withdrawal rate you want to use. Okay, so we have a lot of questions already. So so we always get this question. So we're going to go through a couple questions on the first slide before we get to Shani's good slide. So I have a question for Rachel. So she said, given that in Australia, superannuation and pension phase has a minimum drawdown level that exceeds 4%, how can the 4% rule apply? Obviously, funds outside of superannuation would be required. Okay, so the way that it can still apply is yes. In many cases, including with superannuation, you do have forced withdrawal rates from your accounts. It doesn't mean you have to spend the money. So you can still take out whatever is mandated from your account and then just save the money outside of superannuation and invest the money outside of superannuation. So all that's doing is taking that required withdrawal rate and investing the money somewhere else. So just because you have to take a certain amount of money out of your super doesn't mean you need to spend it all. So that would be my answer to your question. All right, so we've got another question. Okay, well, all right, so this is true. We've got a question saying, even if the 4% rule is for drawing down your funds for 30 years, you could still retire at 40, draw down until 70, and then apply for a state pension. Yes, absolutely. You just have to make sure that there would be a state pension when this happened. But yeah, no, you could. All right, another question from, not another question, a question from Rodney. Presumably with people living longer, and expected future returns being lower, that 4% is too aggressive now. What's the new magic number? Yeah, so what I would say is I agree with both the things you were saying. That's why I was very careful saying 30 years. And I obviously don't have all the stats in front of me. But if you go and look at life expectancy, and particularly life expectancy for people who make it to like 60 years old, yeah, it's pretty high right now. So I'd be worried about that 30-year period, depending upon when you retire. And yeah, I would be very careful, Rodney, as you were saying, I'd be very careful with that 4% rule, given where we are from a valuation perspective. Remember, the higher the valuation levels we have, the lower the expected future returns are. So I would be worried about that, particularly, as I said, with fixed interest. What people have really done is what they've done is they've gotten a lot more aggressive in their portfolios. And we'll talk about asset allocation later. But 60-40, which used to kind of be the standard portfolio, really doesn't exist anymore. People are now saying, and I hate it when people say this when they're like 30s or the new 20s, but people say like 80-20 is the new 60-40. So yeah. All right, so we've got a good question from the anonymous attendee, but we'll get to that in 1 second. Will, you're writing apologies? There are audio issues? What a blessing that people don't have to hear me. All right, so let's talk about why this 4% rule is important, and let's talk about why this financial advisor went back and created this. So the worry that he had was sequencing risk. So sequencing risk refers to the order of the returns you get, as opposed to the average return. So you can have these same average returns, which is what we're going to talk about on this slide, the same average returns, but depending upon the sequence of those returns and how that relates to when you retire, you can have vastly different outcomes. So that is our concern with sequencing risk. That is why he had to go back there and run all of these different scenarios, in his case from 1925 to 1994, rather than just saying the stock market returned an average of 6% a year and then using that average to go through the scenarios of the withdrawal. Because sequencing risk matters. And it matters because if you are about to retire, or if you're just in the beginning of retirement and the market goes down significantly, if your portfolio goes down significantly, you have a lot worse outcomes than if the opposite happens. And so I was doing a podcast earlier today with this great woman at NAB Trade called Gemma Dale, and she was talking to me about a friend of hers who retired right in the GFC. So retired 3 months before the markets went off a cliff in the GFC. So that is really bad. And that person ended up going back to work. So let's talk about sequencing of returns. So the problem you run into is when you start switching from accumulating assets in your portfolio to taking them out to pay for a retirement, if there's a big market drop while you are pulling funds out, it's very, very difficult for you to retire. Or it is very damaging to your portfolio. So let's look at a couple examples. So in this case, we've got a withdrawal rate. So we're doing the 4% rule. So the 4% rule also says that every year you can increase your withdrawal rate by inflation. So here we go. $1 million, we're taking out 4%. So we take out $40,000, but there's big falls right at the beginning in the total return in this portfolio. So what is that doing? Well, all of a sudden your portfolio is falling very, very quickly. And even though we've got higher returns that come later, the problem is that you have less you're not saving anymore, right? So you're pulling money out when the market is low. So you're selling assets when the market is low, and you're pulling money out of your portfolio, and that can create a real problem. So you can see the reduction in this portfolio. So what that does is that increases your longevity risk if you have bad luck in terms of when you retire. So longevity risk, of course, is the risk that you outlive your money, which nobody wants to do. We were talking about eating out of a dumpster the other day, but that could be an impact, right, Shawnee? Okay. The reason, and this was the question we had from Rodney, the reason that we could potentially be very concerned about this is because of equity market valuations. So I could go through a bunch of these, and we've done this multiple times. What is that slide? And we've done this a lot. I should have looked through here, Shawnee. We've talked about all these different valuation techniques. So, but the CAPE ratio is an interesting one, and we'll just use this one. So basically, all of these things are telling us that the market is a lot higher than it traditionally has been. So the CAPE ratio is the cyclically adjusted price to earnings ratio. So all that means is we're looking at a 10-year period. So instead of looking at a 1-year snapshot of price to earnings ratio, we're looking at a 10-year period. That is going to allow us to adjust to fluctuations in both the market and earnings, and sort of smooth out some of those bumps we get. So historically, it's between 10 and 20. Currently, it's 26.1, and I think it's actually a little higher now. There are 3 instances when this happened: the GFC, the dot-com bubble right here, And this is a little crash that caused the Great Depression. So this is why people are very concerned about this. So once again, valuation levels are going to dictate the returns that we get in the future. So yeah, that could be a problem. I'm going to skip the next slide because I don't know why it's in there. And we'll go to this one. So there we go, moving forward. Shani is laughing at me. So what are we trying to do during retirement? The reason that we talked about, we of course talked about sequencing risk. Now, so what do people often do? Obviously, as they get older and they get closer to their goal of retirement, they are going to try to reduce the volatility in their portfolio, so the amount that it bounces around. And they're going to do that by, of course, reallocating portions of their equity portfolio into something that's lower volatility, like a bond or like cash. So basically, at the end of the day, this is what we call the glide path. And the glide path assumes that over your lifetime, your portfolio is going to be less volatile because you are going to pull money out of growth and put it into defensive assets. So this is an example of a glide path. Now, we're going to talk about some very specific asset allocation in reference to something that is called the bucket portfolio. So this is where you're going to see the difference between the slides I create and the slides Shani creates. So we're going to talk about the bucket approach. And the bucket approach is something that has been designed to help with all of the different risks we are talking about. Sequencing risk and how that can impact your portfolio or impact your retirement depending upon when you retire. And of course, longevity risk, which is associated with that. So let's talk about the bucket portfolio. All right, so this is the slide I created, which should be obvious. So we have 3 buckets on here. And I always say, so we've got Will, who is apologizing for the sound, who is producing these things, and then Shani, and each one of us have a bucket in here. So we'll start with the first bucket, which is Shani's bucket. So that is the KFC bucket because Shani loves KFC. I went over for a drink at Shani's place last night and she ordered chips. Not from KFC though, but you like fried food, which is good. All right, so how does the bucket approach work? What the bucket approach does is it divides your money into 3 different buckets. So we've got bucket 1, Shani's bucket. So the idea here is that you put, and it could be 1 to 2 years. If you're more conservative, it could be 5 years. You take a certain amount of your assets and you put them in cash or cash-like investments. So short-term fixed interest as well. If you'd want to do that, honestly, at this point, you're not getting much of a difference in yield. And the reason you're doing this, the reason you're putting this bucket 1 in place is because this protects you from volatility. So what this means is, we talked about that scenario where if the market falls a lot as you're retiring, and right as you start retirement, that you are selling assets to fund your retirement. You're selling them at low valuations, and that's money you're just not going to get back. So this protects you. What this allows is for the equity portions of your portfolio, which we'll get to in a second, it allows them to hopefully recover as the market recovers without you selling any of those assets because you are pulling cash out of bucket 1. So then we have bucket 2. That's my bucket. I mean, I also like fried chicken and whiskey and beer, but we each have to have our own buckets, right? So bucket 2, so the idea behind bucket 2 is we have intermediate term assets. So what that means is, once again, we're thinking about volatility here. They are lower volatility assets. Now, it's very difficult, and I'll give you a little caveat about the bucket approach in a second. It's very difficult right now, obviously, to find assets to go in bucket 2 that you're getting any sort of return on. So we'll talk about a hybrid in a second. And then, of course, bucket 3 are long-term assets. That's where you're keeping your growth assets. So your listed property, your equities, infrastructure investments, et cetera. And what we do is we replenish this bucket 1 all the time. And we replenish it. We can replenish it from income. So if you have dividend-paying stocks, we can replenish this first bucket. We can also, of course, replenish it with the proceeds from sales of some of these assets that you're selling off. All right. So what I would say about the bucket approach, and you rebalance, of course, between the buckets. What I'd say about the bucket approach is, in my opinion, and my mother, who's on here, because apparently Shani says she's on here because she loves me. I was going to say because she has nothing better to do at 10 o'clock at night in Tennessee. But I've been doing a hybrid approach with my mother, basically using a 2-bucket approach. And the reason I'm doing this is because I can't see a big difference between this bucket 1 and bucket 2, given where we are from an interest rate level. So if we were in more normalized interest rate environment, if you were getting 4 or 5% from bonds as you used to, then yeah, stick them in bucket 2, and bucket 1 can be cash. There isn't a whole lot of a difference right now. So you go out and get like a 10-year U.S. Treasury. So what, it's at like 1.7 or something like that? Shani's shaking her head like, why am I asking her that? So you're not getting a huge difference. Obviously, that's more than what you're getting for cash, but there's risk associated. So you can also do a 2-bucket approach. If you're doing a 2-bucket approach, my recommendation is you have that bucket 1 not be 1 to 2 years of living expenses, but build it out. So I think I've got 5 in my mother's KFC bucket. So yeah, that is the bucket approach. And we've got someone at Morningstar, Christine Benz, who's in Chicago. And what she's done is she's taken this bucket approach and she's created a strategy for retirees, which we'll get to in a second. But first, I think we have a couple questions. All right. Okay, so Martin's asking, using the bucket example, during drawdown, is the income from bucket 2 and 3 reinvested, or do they become part of bucket 1? Yeah, so what you want to do is you do want to, whether it's a 2-bucket or a 3-bucket approach, I've never said bucket so much. What you do want to do is you obviously want to replenish bucket 1. So at the end of the day, let's say you have 5 years of cash sitting in bucket 1. You take out a year of cash to fund your life. Well, you've got to fill that bucket back up if you want to maintain that 5 years. So dividends being reinvested or income being reinvested, that's fine, but that just means you'd sell assets. So it obviously, like in a perfect scenario, you're generating enough income, dividend income or income from wherever else, you're generating enough income to fill up that bucket all alone. That is a perfect scenario. That does not mean nothing bad can happen to you, but it is a lot safer. There can obviously be dividend cuts and things like that. But at the end of the day, you're not as worried about assets. Shani is peeling off her what's it called? Your nail polish. Things are getting bizarre here. But yeah, so Martin, what you do want to do is in some way you need to replenish that bucket. So whether you're doing that with income or whether you're selling off assets, that's the idea. All right, so we've got a question. So how often should the buckets be rebalanced? On an annual basis, right? Because on an annual basis, you got to replenish that bucket 1 because you are taking money out, right? So you're taking money out of that bucket to actually live. So let's see. So a question from the anonymous attendee: how do you draw down from pension accounts when financial markets show volatility while returns are still positive? So I don't think I understand the question, unfortunately, which is not your question. It's probably me. So volatility. So you're saying there is volatility within a year, but the returns are still positive. Maybe that's what you're saying. Sorry, I just don't understand the question, but that's my fault. So apologies for that. Yeah, so Susan's asking another question about the 4% rule, a little confusing in practice, as the minimum pension drawdowns are higher than this. With the exceptions of the temporary COVID changes. Yeah, don't get me started on those. I have opinion. Shani's moved her computer, so I can't see her pulling her. All right. Wow, that's not the finger I thought you were going to stick up. Yeah, so same idea, Susan, that just because you are forced to take money out of a pension account does not mean that you actually have to spend it. So yeah, just be wary that, if you are being forced to take out you put it here, 5% from 65 to 74 and 6% from 75 to 79. Just because you're being forced to take that money out doesn't mean you need to spend it. So there are differences. All right, so it looks like, yeah, so Eileen is saying, would super fit into a two-bucket approach? So you take some cash out of your super when you retire and then take the required mandatory each year from your super to add to your cash. Yeah, absolutely. It's obviously, Eileen, it's very, very personal, and it's based on your personal situations and where your assets are. Are all your assets in super? Do you have assets outside of super? And that's where there's tax ramifications and all sorts of things that you need to consider. So yeah, that's probably a situation where there's no one size fits all. All right, so we're getting a lot of questions about asset allocation. So we're going to move on. So this is Shani's slide. So this one's a lot better. So she created this. It's hard to believe that the person picking her nail polish off created this slide, but yeah, no, she did. So this is once again the same thing. These same three buckets that are less creatively put on there than mine. But yeah, so basically, once again, it is a rotation, as you can see, as assets move amongst the different buckets. But I think what people really want to talk about is Shani's second slide. So Christine Benz, who is a financial planner, works for Morningstar in the US. She's she's director of personal finance, I believe is her title. I've been reading Christine Benz for long before I worked at Morningstar. I think she's great. We publish a fair amount of her stuff on our website. The one thing is she is American, obviously, with a lot of this, obviously tax and different retirement accounts play a big role. So you're going to hear a lot about 401ks and IRAs and stuff like that. But anyway, what she's created what she calls a bucket strategy for retirees. So the bucket strategy for retirees is on our US website. So it's just morningstar.com. Or that .com.au stuff, but you can Google it. Christine Benz, B-E-N-Z. Look at me. Christine Benz bucket approach for retirees. And you go on there, and what she actually has done, which I would like to replicate in Australia, is she's gone through and looked at different ETFs, and they're called mutual funds in the US, but managed funds, and put them into these different portfolios. Now, those aren't available in Australia, obviously, but you can go look at some of the stuff that she's put in there. And we've got, equivalent products in Australia. All right, so she has come up with asset allocation suggestions for different types of retirees. So let's go through these different types, and I can tell you how this works. So she's got a conservative portfolio. So the point of the conservative portfolio, and I will read so I don't screw this up, is preserving purchasing power and delivering living expenses for the retiree who has an approximately 15-year time horizon. That means life expectancy. Once again, you don't know this, but if you just have a sense, you've only got 15 years left. I have that sense, less. Shani thinks 3 years. So if you have a sense, that's what the conservative portfolio does. So we'll go through it each one of the how we've divided these up. Then we've got a moderate portfolio. So the moderate portfolio, the conservative portfolio, the focus is on capital purchasing power preservation and income production. And that's why it's allocated like it is, which we'll get to in a second. The moderate portfolio assumes a 20-year time horizon and less of an appetite for short-term volatility. And then the aggressive portfolio is geared towards retirees who expect to live 25 or more years in retirement. So the goal there isn't to generate the best returns of any retirement portfolio, but just to help retirees and pre-retirees visualize what their long-term strategic asset allocation should be. All right, so let's go through and look at these and how they compare. All right, so what do we have here? We've got our three buckets. So once again, bucket one is cash. So they're basically just telling you your cash levels. So if you look at these cash levels within the context of the 4% rule, you can see how much Christine is allocating into each one of these portfolios from a cash perspective. So aggressive, 2 years of cash. Moderate, 2.5. And I'm just dividing these by 4%. And then 3 years for conservative. So I'm off the charts conservative, I would guess, because my mother is My mother has 5 years of cash. And somebody, once I did this and somebody wrote in, you're really nice to your mother that you help her invest. And I answered that I don't want her moving in with me. So it's like a self-preservation thing. So I'm sure she's appreciating that if she's still awake. It is late in Tennessee. All right, so we go into bucket 2. So bonds and income funds. So once again, bonds, not a great time to invest in bonds. So this would be some of those lower volatility equity funds as well, from an income perspective. So think about low volatility. We are looking for things that pay dividends. So we look at some of the stuff, higher dividends, lowers the volatility in portfolios generally. We're looking for more quality companies here. And you can actually go in and if you look at funds and ETFs, you can find funds and ETFs that are geared towards higher quality, lower volatility stocks. So your neighbor who has put all of their money into Bitcoin is going to be laughing at you with your high quality dividend focused fund, but that's okay. So you can see the different allocations here. Then if we move to equities, so now we're looking more on the growth side of equity funds, along with some income as well. So now what we're talking about is potentially higher volatility equity investments where you're not as focused on income. So, and the time frame she put in here is, of course, the investment horizon that you're looking for in these different buckets. So what you can see in all of these bucket portfolios, she is allocating, a lot more to equities than traditionally anybody would with these 60-40 portfolios. So that's really the idea behind the bucket asset allocation. It's a very good slide, Shani. All right, so we've got a couple of questions. I don't understand that one. Okay, well, here's some good questions. Linda says, is the family home included in the bucket strategy figures? All right, so now this is where all of Australia shows up with torches and pitchforks and comes to get me, because I'm going to say something about housing. All right, the problem with housing, of course, is that if it's your primary residence, you got to figure out a way to get money out of your house, or you can downsize, obviously. There is a portion, if there's a time where you are going to downsize and sell your house or move in the same house to a cheaper location, then yeah, we can talk about the family home. But what you need to think about is, are there ways to actually get money out of your home? And of course there are, right? You can borrow from your home, but you need some way to turn, I know it's an asset, but you live there. You need to find some way to turn that home into an asset that's actually generating cash flows for you. So the problem with housing, particularly the house that you live in, is that it's great that the thing's appreciating, but that doesn't matter if you're not going to move. So I think that, Linda, I just sort of consider, I guess, what your strategy is. You could take in flatmates. I don't think that's a very popular approach to retirement, but that could keep you young if you have somebody move in. Nobody seems interested in the room in that. James said, did you answer the lack of audio problems by speaking live? I don't know what that means, James. Yeah, I could speak live. You can come sit in the room here with Shani and Will. Bring a bucket of chicken for Shani and a whiskey for Will, and they will be happy. Oh, James said he's going to look at the video later. I'm sorry. Okay, so Lisa is saying, of course, alpaca fame. Sorry for not giving you the proper introduction. She's trying to understand what goes into each bucket. Where do I look for the total? So what we're doing here is, if you go and you add these things up, so conservative portfolio, 12% of your portfolio is in cash. 53% is in this second bucket, bonds and income funds. And then 35% is in the equity bucket. And because I trust Shani, I know that these all add up to 100%. So basically, that is how you're supposed to allocate your portfolio within these different buckets. So hopefully that answered your question. All right, here we are, out of questions. Well, that's exciting. Okay, well, if you have any other questions, send them through now. Why don't you come on and talk about it? Is there another slide I missed?
It's in the notes, so the second feedback one.
This slide. Okay. I don't know what you're talking about, but anyway, if anyone has any questions, please send them through. I'm clearly missing something here.
Sorry.
Oh, jeez. All right. Okay. Shani wants me to talk about bucket maintenance, which sounds like that song, the hole in the bucket song. You never heard that? Okay. It's like a song for children in the US. There's a hole in the bucket. Anyway, it's a song. Okay, so there are a couple different ways that Shani would like me to talk about bucket maintenance. So there are a couple different ways you can do that. So number one, you can move. You can go with the mechanical approach, which doesn't sound exciting. So basically, what that means is a retiree would move assets from bucket 2, which is more of the intermediate term. Yeah, there we go. So people understand the song, Shani. So the mechanical approach. So a retiree would move assets from bucket 2 to bucket 1, and from bucket 3 to bucket 2 on an annual basis. And basically what that means is over time, your entire portfolio is getting more conservative, right? So we're sort of seeing this rotation from the more long-term bucket into the more conservative buckets. So it's easy to do this approach, and you do reduce risk over time. So as you get older, you are lowering the volatility of your portfolio. The problem with this approach that if you are doing this in a mechanical way is, of course, you're not looking at what's happening in the markets, and you're not looking at valuation levels and trying to figure out whether this is a good time to do this. So in this case, you wouldn't necessarily want to do that if we were in a big bear market, because remember, you're selling your long-term assets like equities when they are really cheap. So that's a consideration for that bucket. The next bucket approach is one that we sort of alluded to before. It's the income approach. So what that means is bucket 1 is just filled with whatever income. So anything that's generated from dividend-paying stocks, from interest you receive on bonds or bank accounts, which is kind of laughable, hybrids, anything you're invested in, that income is just moved into bucket 1. Now, this is the approach you want to take if you have enough money to actually do this. And that's what I was referring to later, is that you are not selling off any of your principal. It's a really good position to be in, but it also means you either have a lot of assets or you can survive on a very low withdrawal rate. So that is that's that issue with the other approach. I love the names of these things. I know that you didn't make up the names. The next bucket rotation approach is called the strict constructionist approach. It's a good name, huh? So that sounds like a legal philosophy or something. Oh, I'm a strict constructionist. Okay. The Catholic approach. Okay, thank you for introducing religion into this, Shani. So what this approach is, a retiree reinvests all income, dividends, and capital gains back into his or her holdings. The retiree then refills bucket 1 with rebalancing proceeds. So basically what you're doing is you're periodically rebalancing by selling assets that have performed well and then moving that into this other bucket. So the good thing for this is you are actually taking valuations in a way into account. So you're selling off assets that are performing well, keeping assets that are not performing well, hoping that they will, of course, rebound. So this could be an approach that you would use during a bear market. So in that case, stocks could go down a lot, perhaps bonds would go up. You'd sell off your bonds to replenish that bucket. So that's another approach you can take. You can also rename it. If we bring this to Australia, we need to rename it. Who do you think should be in charge of renaming it? Me after a few whiskeys. Okay, yeah, that's going to happen tonight. The next one is the opportunistic approach. So what that means is income distributions from cash, holdings, bonds, and dividend-paying stocks are automatically transferred to bucket one. But if those cash payments are insufficient to fill up bucket one, so this is a case where most people don't have big enough portfolios to just live off of the income. So if they're insufficient, then you start rebalancing. And this is where you can do, if you're in taxable accounts, tax loss harvesting. There could be obviously minimum required distributions that come out of your accounts. So this is where you are opportunistically looking to rebalance and sell assets, but you're also sort of combining it with that dividend approach. And this is where we're really taking valuation levels into account. And yeah, the good thing about this is your withdrawal rate's the same, but the amount of assets you need to sell is lower because you are taking income. Are you happy now? Is that what you wanted me to do, Shani? Okay, Shani's happy. All right. All right, so Lisa is saying, what if I'm already in retirement? Well, Lisa, you can sell off your alpacas. I don't know which bucket they would go in. Lisa gave me the whole investment thesis behind alpacas. When they start producing, I assume wool is what you're interested in here, and then how long they live. So I know a lot about alpacas now. So Lisa says, what if I'm already in retirement? Do I use the same bucket approach, or is there another bucket for drawdowns? That bucket one is your drawdown bucket in terms of drawdowns that you're actually going to spend. So that's really the idea of that bucket one, that all the money that goes out of an investment account and into your transaction account so that you can go buy, I don't know what alpacas eat, but some of their food, that comes out of that first bucket. All right, so Colin is saying, I've had trouble finding Zoom meeting recordings during April and even last week. The link in the registration doesn't show recent recordings. All right, we need to update the link in the registration, Shani. But what you should do, Colin, that's my fault. I did this. Shani went on leave and the wheels fell off with everything. What you can do, Colin, is Google Morningstar Australia YouTube. And if you go on to our YouTube channel, Will has put up all of our recent ones, so for the past couple months, on YouTube. So you can go and see them on YouTube, but we will update that link. So I'm sorry, that is completely my fault. All right, so Terry is asking, is it better to hold on to more cash in an overvalued market rather than risk investing more into bucket two? Okay, so let me think how to answer this. There is strategic asset allocation, and then there's tactical asset allocation. And I'll stop sounding like a financial services idiot in a second and try to explain that. So strategically, you can set an asset allocation target. So that can be this bucket approach that, okay, I know that I want these different amounts in the different buckets. So you can do that. You can also have a tactical asset allocation where you can sit there and say, I think markets are really overvalued. I am going to build up some cash, which I will then reinvest. So this is not building up cash because you're going to take it out of your portfolio, whether you're retired or not. This is building up cash so that you have the opportunity to take advantage of opportunities in the market. So namely, when the market falls. And to go back to this Gemma Dale conversation I had, so she works for NAB Trade, and she obviously has access to not individuals' accounts, but aggregate level data from NAB Trade customers, and that's what she's seeing. So NAB Trade customers, the way that she was describing it, are generally older, more sophisticated, more conservative, their investments. So she's seeing a lot of this now where people are building up cash in their portfolio. They're not doing that from like a bucket approach perspective because they're about to take it out. They're doing that so they can be opportunistic if and when the market falls. So yeah, I think you can certainly build up cash right now if you believe the market's overvalued and there'll be opportunities. All right, Martin has, I don't know what this is, Martin. Why sell your flowers? Perhaps sell the weeds. They may always be weeds. So my knowledge of literature is not sufficient to understand where that quote came from. Rodney has sent a link of the YouTube videos on Morningstar, which is nice, but I don't think people can see this, but I can send it to people who can see this. So thank you for doing that, Rodney. Maybe you should come while Shawnee is on leave and make sure I don't screw everything up. Look, multiple people know my little bucket song, by the way, Shawnee. When Shawnee was younger, the only thing that you were into was Harry Potter. Yeah, so she tells me she used to like dress up in Harry Potter clothes and go to school. And to this day, Shawnee has Harry Potter slippers that she wears around her apartment. It's interesting. Colin subscribed to our YouTube channel. Now Will is happy. Thank you for doing that. All right, so Peter's asking, does a super fund balanced account in pension mode count as bucket accounts given they have 15% cash? Yeah, so what we're looking at there, so with super funds, if you're not in a self-managed super and you are instead selecting from one of these just pre-configured asset allocations, yeah, perhaps you can compare that to the bucket approach. The only thing that I'd be careful with about, Peter, is like how the money comes out of those accounts. Now, I can't say that I have an industry super fund, for example, but I can't say I've thought too much about taking money out of it. So the question, of course, is if you're in a balanced portfolio and you have a withdrawal, I assume they're just going to sell a little bit of everything. So you are pulling stuff out of the cash part as well as an equity portion. But I should look into that. So Martin is clarifying this weeds. So he's saying selling good stocks versus selling bad stocks to provide income. Yeah. Okay. Sell bad stuff. See, look, Will, I put up the link as well, as did you. All right, we're on the same page. Okay, so I think we're going to end this now because there are no more questions. But if anyone has any questions, please send them through to mark.lamonica1@morningstar.com, and I will get back to you hopefully tomorrow. All right, thank you guys very much for joining. I will see you on Tuesday where we'll talk about something else, which I don't know what it is. Thank you.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.